identifies potential buyers including 21. Investment banker roles, sell-side versus buy-side mandates. Sell-side investment banking services. Marketing and buyer identification. Sell-side investment banks manage the entire sale process, from preparation through closing. The bank prepares the teaser document providing anonymous company overview to gauge buyer interest. After NDA execution, the bank distributes the information memorandum detailing business operations, financial performance, and growth opportunities. The bank identifies potential buyers including strategic acquirers and financial sponsors. Strategic buyers seek operational synergies while financial sponsors focus on financial returns. The bank leverages industry relationships to approach qualified buyers discreetly. Valuation and deal positioning. The bank conducts comprehensive valuation using discounted cash flow analysis, comparable company multiples, and precedent transaction benchmarks. Valuation work establishes the price range guiding LOI submissions and negotiations. The bank positions the company highlighting competitive advantages, market position, and growth trajectory. Effective positioning creates competitive tension among buyers, driving higher valuations. Auction process management. The bank runs structured auction processes managing multiple buyers simultaneously. The process includes management presentations, allowing buyers to assess operations and strategy. Data room management provides buyers controlled access to due diligence materials. The bank coordinates site visits, reference calls, and Q&A sessions. Bid evaluation compares offers across price, structure, certainty, and timing dimensions. Negotiation and fairness opinion. The bank negotiates transaction terms on behalf of sellers. Negotiation addresses purchase price, payment structure, representations and warranties, and indemnification provisions. The bank issues fairness opinions opining whether the transaction price is fair from a financial perspective. Fairness opinions protect board members from shareholder litigation alleging inadequate price. Investment banking services. Target identification and screening. Buy-side banks help acquirers identify acquisition targets fitting strategic criteria. The bank builds target lists using industry databases, market intelligence, and proprietary relationships. Desktop screening evaluates targets using public information before confidential outreach. The bank makes initial contact with target management or shareholders gauging sale interest. For proprietary deals, the bank leverages relationships facilitating introductions that internal teams cannot achieve. Valuation and deal structuring. The bank develops valuation models supporting price negotiations. Analysis includes standalone DCF valuation and synergy quantification. Deal structuring addresses stock versus asset purchase, financing mix, and earn-out provisions. The bank advises on optimal structure balancing tax efficiency, risk allocation, and seller preferences. Financing arrangement. The bank arranges debt financing for acquisitions requiring leverage. Services include preparing bank presentations, negotiating debt terms, and syndicating loans across lenders. For large transactions, the bank underwrites bridge financing providing certainty of funds. The bank coordinates equity financing when buyers use stock consideration. Negotiation support and due diligence coordination. The bank supports buyers throughout negotiation, advising on tactics and terms. The bank coordinates external advisors including lawyers, accountants, and consultants. Weekly coordination calls align work streams and maintain deal momentum. The bank identifies deal-breaking issues early, enabling proactive resolution. Case example: Dell acquisition of EMC. Structure comparison. Fee structure comparison. Sell-side fee models. Sell-side mandates typically include monthly retainer fees and success fees. Monthly retainers compensate banks for upfront work, preparing marketing materials and identifying buyers. Success fees are calculated as percentage of transaction value using tiered structures. The Lehman Formula historically used 5% on first million, 4% on second million, decreasing thereafter. Modern deals use custom fee schedules negotiated based on deal size and complexity. For a $500 million sale, the success fee might be structured as 1% on first 100 million, 0.75% on next 150 million, and 0.5% on remaining 250 million. Buy-side fee models. Buy-side mandates also combine retainer and success components. Buy-side retainers tend to be lower than sell-side because marketing preparation is unnecessary. Success fees on buy-side are typically lower percentages than sell-side, reflecting different value proposition. Some buy-side mandates use fixed fees rather than percentage-based success fees. Performance bonuses may be included, rewarding advisors for achieving specific outcomes like price reductions or favorable terms. Engagement structure options. Full-service mandate. The bank manages entire process with minimal client involvement. This model suits sellers lacking M&A experience or bandwidth. The bank selects all other advisors, including lawyers and accountants. Full control enables seamless coordination, but reduces client oversight. Limited mandate. The client manages overall process while bank provides specific services. Services might include only valuation or only buyer identification. This model suits experienced clients with strong internal teams. Lower fees reflect narrower scope but requires more client resources. Success fee, misalignment, common conflicts of interest. Success fee, misalignment. Success fees create incentive to close deals regardless of price adequacy. Banks earn more from completed transactions even at suboptimal prices. This conflict is stronger on sell side, where any completed sale generates fees. Buyers should independently validate bank valuation recommendations against market data. Cross-selling and relationship conflicts. Banks may prioritize relationships with frequent clients over one-time clients. A bank advising a seller might steer buyers toward lenders where the bank earns financing fees. Banks representing both buyer and seller in different deals face divided loyalties. Clients should ask banks to disclose all relationships with counterparties. Staple financing conflicts. Sellers sometimes arrange staple financing where their bank provides pre-approved debt to buyers. This creates conflict as the bank advises seller while lending to buyer. The bank may push sellers toward buyers most likely to use the stapled debt. Buyers should obtain independent financing quotes rather than accepting stapled packages. Mitigating conflict risks. Engagement letters should require banks to disclose material conflicts. Clients should obtain multiple valuation opinions from independent sources. Fee structures can include clawback provisions if deals unwind quickly. Boards should ask probing questions about bank recommendations rather than deferring blindly. Strong internal teams provide check on bank advice, preventing conflicts from driving decisions.